Hello, this is Dr. Mankiw. Welcome back to Chapter 4, Part 2. In this video, we're going to be building a model of the money supply that's a little bit more sophisticated than the simple money multiplier we ended with in Part 1. But it's also simple enough that you can work through it pretty easily. So before we can build the model, let's do a couple of definitions. And so we're really going to be working with the algebraic definitions that we see on the right-hand side here. So the monetary base is also referred to as high-powered money. So this is the part of the equation that's controlled by the central bank policy. So if the central bank decides to do open market operations, they are manipulating the amount of reserves in banks, which is a big part of the monetary base. The monetary base, B, is defined as currency plus bank reserves. The next definition is the reserve to deposit ratio. So we're going to call this RR. We saw this in the previous slide. So this is defined as the amount of reserves divided by the amount of deposits. So it's the ratio of reserves to deposits. So we used to think of this as being determined by regulatory minimums. Banks had to keep a certain number of minimum reserves to meet laws, but these days that has actually been retracted and there is no legal minimum anymore. And so it really depends on bank policies these days. We operate in what the Federal Reserve calls an ample reserve environment now. So the minimums essentially didn't mean anything anymore because banks were holding much more reserves anyway. So you can think of, again, these reserves as sort of a buffer against bad things happening. So if banks feel threatened or they want to reduce their risk profile, they will hold more reserves. If they want to try to make as much profit as possible, then they're going to hold fewer reserves and turn those into income generating activities. So the final definition here is the currency to deposit ratio. So we know what currency is and we know what deposits are. So the currency deposit ratio, CR, little cr, is simply the total amount of currency divided by the total deposits. And so this is a household behavioral item. So think about what makes you want to hold more cash. Well, if you're worried about the bank losing your money, then you're going to want to hold lots of cash. If you feel very comfortable with the banking system, then you're willing to put your cash in the bank. Technology can affect this. So if you have technologies that allow you to use cash very efficiently, then you don't need to hold as much cash. If you're getting ready to buy something, so you're gearing up to make a bunch of purchases, you might want to hold more cash. So there's a lot of different, sort of behavioral items that we can sort of associate with this currency deposit ratio. So based on the definitions we just talked about, we can build this model of the money supply to get a little bit more intuition about what are the important factors that determine the size of the money supply. So remember, we started with the definition of money. The money supply at big M is equal to currency plus deposits. So we can just do a little bit of an algebraic trick here. We can multiply by B over B, which is just equal to 1. So we can multiply this by B and divide C plus D by B, and we're leaving this C plus D unchanged. We're just multiplying this by 1, but we're using this sort of as a little trick to introduce the monetary base into the formula. So after multiplying by B over B, we can say that the money supply, big M, is equal to little m times B, where this little m, if we go down here, little m is equal to C plus D over B. So we're just saying this term right here is equal to little m. So ultimately, we end up with an expression for the money supply. The money supply, big M, is equal to little m, the money multiplier, multiplied by the monetary base. So we can then use the definitions we talked about in the previous slide to do some further manipulation with C and D, currency deposits, to get a little bit more intuition here about where this behavior is coming from. So if we take C plus D and we substitute in C plus R for the definition of the monetary base, remember the monetary base is equal to C plus R. So we sub in C plus R for B, and we get C plus D over C plus R is equal to little m. We can then do another little algebraic trick here. We can divide each term in this equation here by D. Again, so we're essentially just leaving this expression unchanged, but we're turning these into a series of ratios. So again, it's similar to multiplying by b over b. We're not changing the expression, we're just doing some algebra to again turn these into some ratios here and here and here that we can interpret more easily. So divide everything by d, then we get c over d, which is the currency deposit ratio, plus d over d, which is just the number 1. C over d, again, is our currency deposit ratio. Reserves divided by d is equal to the reserve deposit ratio. So again, the money multiplier, instead of just being the simple expression that we talked about in part 1, is now this term here, CR plus 1 over CR plus RR. So now let's think about the intuition here. Where do all these different economic agents play a role? So remember, the Federal Reserve determines the monetary base by manipulating reserves through open market operations. So the money supply is determined by the Federal Reserve's manipulation of the monetary base, but it's also determined in part by the money multiplier. The money multiplier is determined by how much currency households want to hold relative to deposits, and so this is, this portion here and here is determined by household behavior. This reserve deposit ratio is determined by bank policy. So they're deciding how many reserves they want to hold relative to deposits. The combination of that household behavior and that bank behavior is going to give us this money multiplier, little m. So as long as RR is less than 1, in other words, if we operate in a fractional reserve banking system, if RR is equal to 1, that means banks are holding 100% of their deposits as reserves. So as long as the reserve deposit ratio is less than 1, then this little m is going to be a number that is greater than 1, right? So something plus 1 divided by something plus something less than 1 is going to give you a number that's greater than 1. That's all that this is saying here. So the m is greater than 1, and that's why we tend to call it the multiplier. So if the monetary base changes by a certain amount, we would call that delta B, then ultimately the money supply is going to change by little m times the change in the monetary base. In other words, the change in the money supply, delta m, is going to be equal to whatever number this turns out to be, the money multiplier, multiplied by the change in the monetary base. And so this is going to be the basis of some homework problems. And so if the question is asking you how does the money supply change, well, you're going to have to figure out what is the money multiplier, figure out how much the monetary base is changing by, and multiply those two things together to get your change in the money supply. Another way to interpret the money multiplier is the increase in the money supply resulting from a $1 increase in the monetary base. So if reserves go up by $1, then the money multiplier goes up by little m, the money multiplier. Just to do a quick example here, so let's suppose that the currency deposit ratio is 0.1 and the reserve deposit ratio is 0.2. In other words, consumers want to hold 10% of their deposits as currency, and the banks want to hold 20% of their deposits as reserves, If that's the case, what is the money multiplier, little m? Well, little m is simply what we get when we plug these numbers into our equation up here. So little m is going to be, change to pencil, 0.1 plus 1 over 0.1 plus 0.2. If we add that all up and divide, we should get 3.67. So if the monetary base goes up by $1, then the money supply changes by $3.67. This is the type of question I'd really like you to be able to answer, because this is going to help you to make sense of things you see in the news and interpret and analyze events out in society. So now that we've built this model of the money supply, how should we interpret events that happen? So suppose that something changes household behavior. Let's say they decide they want to hold more of their money as currency. This might happen if all of a sudden households start trusting banks less. If they're concerned banks might go bankrupt, think 2008, 2009, they might want to start holding more currency instead of depositing their money at banks. So how would that change the value of the money multiplier? Well, if households are holding more currencies, what that means is this currency deposit ratio is going to be increasing. So this number is going to increase and this number is going to increase. So you may be tempted to think that, oh, the numerator and the denominator are both increasing by the same amount, so therefore it's going to be left unchanged. But that's not true, because remember, RR is less than 1. So if we add something to 1 and we add something to less than 1, that change is going to have a bigger impact on this denominator in terms of, if we want to think of it in terms of percentage changes in the numerator and the denominator. So if the denominator is increasing by more than the numerator, then that means this fraction here is getting smaller, which means that the money multiplier is getting smaller. And that should make sense. So if consumers are holding more currency, then that means for any increase in B, the money supply is going to increase by less after this household behavior has changed. So what is the intuition for this result? And that's always going to be something I look for on exams. So can you do the math, but can you also explain the intuition logically? What is happening here? And so remember, the reason why the money supply increases by more than an initial change in deposits or the monetary base is because banks are able to lend out some of that money, and that becomes deposits at other banks or gets filtered into the economy through spending. But if households are sitting on that money in the form of currency, then banks cannot lend that out. So the final result is that the money multiplier is smaller, and for any given amount of monetary base, the money supply will also be smaller after households decide to hold more of their money as currency. And this is the sort of thing I'd like you to be able to do for a variety of potential events. So interpret those events through the lens of this equation here, and particularly this money multiplier equation here. And this is just a summary of what I said in the previous slide. So if you want to take some time to pause this slide and read through this and try to make sense of it, I would suggest doing that. So we've just learned that households, commercial banks, and the Federal Reserve all play a role in determining the size of the money supply. But we didn't talk about all the different ways that the Fed can engage in monetary policy. So we have talked about open market operations. And so remember, open market operations is when the Fed buys or sells bonds from commercial banks. And so again, if they want to increase the monetary base, they would increase the number of reserves that the commercial bank has by buying bonds from them, right? So remember, commercial banks often hold, assets like bonds so that they can earn income. So the Fed would essentially buy these from the banks and pay for them by creating new money. So what this amounts to is saying, all right, the Fed says, all right, I'm going to buy some of these bonds, and in return, I'm going to pay you by increasing the amount of reserves you have on deposit at the Federal Reserve. So the Fed just sort of increases the amount of money in the commercial bank's account to pay for the bonds, and that's how the Fed increases the monetary base. But there are other ways that the Fed can control the monetary base as well. And so one way to think of the role of the Fed is to act as a bank for commercial banks. So like the Fed is the bank that Chase or PNC would use. And so again, banks want to hold differing amounts of reserves based on their policy and regulations. And so if a bank finds itself in a little bit of a shortfall of reserves, they can borrow from other banks in what we call the federal funds market, but they can also borrow from the Fed. The interest rate that the Fed charges on loans to banks is called the discount rate. So if the Fed wants to make borrowing more attractive, they could decrease the discount rate. And so we often hear about the Fed wanting to change the federal funds rate. They often change the discount rate in a similar fashion. And so what they're doing is trying to either encourage or discourage banks from lending by changing the cost of those loans. Generally speaking, a bank would much rather borrow from another bank instead of the Federal Reserve because of the stigma associated with using the discount window, which is the term used for when a bank goes to the Fed and asks for a loan. So if you go to the Fed, that means you can't get the loan somewhere else, and that may mean that you're in trouble. It's a signal to the market that the health of your bank may not be as strong as you'd like it to be. So banks tend to shy away from the discount rate, or the discount window, excuse me. Up until very recently, there were statutory minimums on the amount of reserves that bank had to hold. So we would call these the minimum reserve requirements. So it used to be in the neighborhood of about 10%. But since 2020, these regulations have been repealed. So not anymore. So there is no minimum. And so the basic idea is that these minimums were sort of obsolete in any case because banks were holding much more than the minimum number of reserves. So I mentioned that we operate in what the Fed is calling an ample reserve environment. One of the other reasons the reserve requirements is not necessarily needed anymore is that since 2008, as part of the response to the financial crisis, the Federal Reserve started paying interest on reserves. So this is, again, another way that the Federal Reserve can manipulate the amount of reserves on hand. So if the Federal Reserve wants to encourage banks to hold more reserves, they can increase the amount of interest they're paying on those reserves. So if Chase deposits some money at the Fed in their Fed account, they're going to earn the rate of interest that the Fed is paying. If the Fed raises that rate of interest, then Chase is going to want to put more money in their bank account at the Fed. If they have more money in their bank account at the Fed, it means it's not being lent out. And so that's going to sort of slow down the process of money creation. If the Fed wants to give money out into the economy and get banks lending, then they can reduce that interest on reserves. And theoretically, they could even charge a penalty, a negative interest rate, on those reserves if they want banks to sort of, to lend more and to ramp up the money creation process. And one final insight from this whole equation here is that the Federal Reserve has a really tough job because they're trying to ultimately control the money supply, M, and even beyond that, really what they're trying to do is control the money supply such that interest rates and inflation and all these other variables that they really care about are maintained in the sort of range that they would like to see for to achieve whatever policy goals they have at the moment. But they're doing this in an environment where households have an impact through CR, where banks have an impact through RR, and so they're trying to manage all of these different things to achieve the final goal of keeping the money supply where they need to maintain full employment and low and stable inflation. I do suggest spending some time looking at this case study in the textbook on quantitative easing. So quantitative easing is a sort of new tool that was implemented during the financial crisis. And so essentially what they were doing is similar to open market operations, but they were buying different types of securities and they were buying lots of them to really increase the size of the monetary base, hoping to keep interest rates low and stimulate lending and to stimulate economic activity in general. So from 2008 to 2011, during the height of the financial crisis, the monetary base tripled. It's just this incredible increase that we can see here in the time series graph. But the money supply, M2, only grew by about 22%. Well, why is that? Because the Federal Reserve was increasing reserves by using open market operations and increasing lending to banks through a variety of facilities that they were called. But banks were holding on to them. It was just a super risky environment, and banks were reluctant to use those reserves to turn those into investments and loans. And so the Federal Reserve was really trying to, get banks to lend these things out to people, but they weren't. Same thing from 2020 to 2021. The monetary base increased by 52%, but the money supply only increased by about 25%. Similar sort of situation, right? So banks, ultimately the money supply did increase, so the Fed achieved their goal, but it didn't. All of the action of the Fed didn't immediately translate into more money supply because the banks are playing a role also. They were deciding to hold on to a lot of those extra reserves that the Fed was creating. One thing we're going to see in the next chapter is that big changes in the money supply, the monetary base, typically lead to changes in inflation. So more money growth, higher money growth leads to higher inflation. And so there are a lot of people that were worried about this spike in the monetary base ultimately leading to loss of inflation. And that didn't really happen for many years. The story with inflation is quite different right now, as you learned in the first couple of units, so perhaps some of these chickens are coming home to roost a little bit. We'll study the Great Depression in more detail when we talk about economic fluctuations later in the semester. But one of the key features of the Great Depression were all of the bank failures that happened in the early 1930s. So from 1929 to 1933, more than 9,000 banks closed, went bankrupt. So at the same time, the money supply fell by 28%. So the failure of these banks and the drop in the money supply and the sort of decline in money creation that is supported by the banking system was certainly a big factor in making the Great Depression as severe as it was and sort of making the recovery slow. So with that, we saw the same thing we saw in 2008, 2009, when the financial system grinds to a halt because banks are not lending, then the economy really has a hard time maintaining its footing. How would we interpret this event through the lens of our money multiplier equation? Well, this was sort of a double whammy. So consumers lost confidence in banks. We actually saw things that we call bank runs. So when people are running to the bank to take out all their money because they're worried the bank's going to fail. And as we saw before, the bank doesn't keep all of the money that people deposit as cash sitting in the vault. They loan it out to everyone else. So if everyone goes at the same time to the bank to take out their money, the bank does not have it. And so that can lead to a bank failure due to this liquidity crisis. And so we saw consumers lose confidence in banks, running to get their money out. So that increased the currency deposit ratio, which decreases the money multiplier. We also saw banks becoming more cautious because their loans weren't being paid back. So they were holding more reserves instead of lending them out. So that increased the reserve to deposit ratio. Ultimately, this decreased the money multiplier as well. For a given monetary base, a smaller money multiplier leads to a smaller money supply. That's exactly what happened in the Great Depression, one of the reasons why it was so difficult and so prolonged. And looking at the data, we see the same story. So if we look at the money supply in 1929 compared to 1933, we see a 30% reduction nearly. So why did that happen? Well, consumers were holding more currency and fewer deposits. So what does that tell us? The currency deposit ratio is increasing. So we see that down here, the currency deposit ratio going from 0.17 to 0.41. What happened to reserves? Well, banks were getting more cautious. Reserve to deposit ratio went from 0.14 to 0.21. And so again, both of those things had to change for the worse on the money multiplier. So the money multiplier shrank from 3.7 to 2.3. So a 38% decline in the money multiplier, and that's what ultimately led to this change in the money supply. So even though the Fed was actively trying to increase the money supply, they weren't acting, swiftly and with enough conviction and severely enough in order to overcome these other things that were happening. So in other words, the Fed needed to be much, much more aggressive to overcome this decline in the money supply. One similarity between the Great Depression and the financial crisis of 2008-2009 is that both of these events ushered in sweeping policy changes that were designed to make sure this sort of thing never happened again. So are the bank runs that happened in the 1930s likely to happen again, these widespread bank failures? No, not really. There's a lot more regulation now, especially federal deposit insurance. The FDIC, you've probably seen that on banks. The Federal Deposit Insurance Corporation. So even if the bank goes bankrupt, for the most part, your deposits are going to be safe and they'll be paid for by the government essentially. Similarly, with the financial crisis of 2008-2009, we see more regulations on banks in terms of capital requirements and the sort of risk profile that they can have, and also bringing sort of non-bank financial institutions under the umbrella of regulation, sort of the regulation of the so-called shadow banking industry. There's also been a lot of changes in Federal Reserve policy as a result of 2008-2009, a lot more tools at the Fed's disposal with quantitative easing and interest on reserves and all sorts of things. So definitely some similarities between these two seminal events. And that wraps up my video for chapter 4, so please let me know if you have any questions. Thanks.